You have probably heard that AI is the future. But what if I told you that the same companies building that future might also be setting up the next market crash? What if I told you that the biggest market risk today is happening right under your nose? AI is booming. Companies are spending hundreds of billions. Stock prices look unstoppable. But behind all this excitement, something doesn't add up. There is a loop of money quietly moving behind the scenes. Governments are pushing billions into it, and valuations are rising for a reason most investors don't fully understand. So the real question is this: are we in the middle of life-changing opportunity or walking straight into financial trap? Well, let's find out. Before we decide whether AI is a massive opportunity or a dangerous bubble, we first need to understand the race that's happening right now and how fast it's moving. The biggest technology companies in the world are no longer spending millions on AI. They are spending hundreds of billions. To give you a real sense of just how extreme this has become, here's what the top 7 tech giants, the so-called Magnificent 7, are now pouring into AI. Tesla is investing 5 billion, Apple is investing 10.7 billion, Meta is investing 60 billion, Google is investing 75 billion, Microsoft is investing 80 billion, and Amazon is investing 100 billions. That's a total of $330 billion being deployed into AI in a single year. This isn't normal corporate spending. This is a full-scale technology arms race driven by the need to build, train, run, and eventually monetize the largest AI models in the history. So why are they spending so aggressively? Well, there are two main reasons. Reason number 1, fear of losing the race. Every company believes that if they don't dominate AI, someone else will, and whoever wins AI might control the next decade of technology. Inside the industry, there is a very real fear that moving too slowly doesn't just hurt growth, it could completely knock a company out of relevance. Reason number 2, holding up entire economy. Here's the surprising part. Some economists believe that without the surge of AI investment, the US might already be in mild recession. That means this AI race isn't only shaping the future, it's propping up the present. The money is flowing so fast, so aggressively, that it's lifting GDP, stock prices, corporate earnings, and even tech sector job growth. But here's where things get even more interesting. This race isn't only being fueled by companies. Governments, both quietly and openly, are pushing billions into AI too. And their reason has nothing to do with excitement and everything to do with $38 trillion national debt and a growing global technology war. And that brings us to the next point. To really understand whether AI is a massive opportunity or a dangerous bubble, you have to understand something almost nobody talks about: the circular financing loop behind the entire AI boom. Right now, money is moving in a circle, a loop where the same dollars keep boosting AI companies, stocks, and AI demand even before real profit exists. This isn't a theory, it's happening right now. What this chart shows is Nvidia invests in OpenAI. OpenAI signs multi-billion-dollar cloud deals with Microsoft, Oracle, and other companies. Microsoft and Oracle then spends tens of billions on Nvidia chips, and that's how Nvidia makes more money. And the cycle repeats across companies like AMD, Intel, xAI, CoreWeave, and others. The mechanism is the same everywhere. One company funds another, that company spends the money back into the system, and everyone's revenue goes up. This is a sophisticated form of demand engineering, fueling customers so they can keep buying, which inflates valuation across the entire ecosystem. This loop can accelerate growth incredibly fast, but it also means the market is more fragile than it looks. Now that we understand the AI race and the circular financing behind it, the next big question is the one every investor secretly asking: is this whole thing going to bust? And the truth is, there are two very different sides to this story. Let's start with the first side. Several signs today look very similar to the year 2000 when the dot-com bubble burst. A lot of the numbers you see in earnings report aren't coming from real customer demand, they are coming from companies buying from each other. Many leading AI companies, including OpenAI, are still losing money despite massive valuation. An MIT study found that 95% of generative AI investments have produced zero financial returns so far. AI models need huge amounts of human created data, and experts says we are running out of it. If models stop improving as quickly, the hype could slow dramatically. The dot-com crash wiped out entirely 80% of the Nasdaq, and only about half of those companies survived. Big innovation can still experience massive crash on the way. And then there is another side of the story which investor can't ignore. Governments, especially the US and China, see AI as a national priority. They cannot afford to lose this race. Over 700 million people use ChatGPT weekly. AI is not just hype anymore. The product exists and people are using them. So is this a bubble? Yes. Is it guaranteed to burst? Well, no one knows. This is what makes the movement so confusing and so important for investors. So after everything we have covered, the AI race, the government push and the circular financing, the real question becomes, what should you actually do as an investor? I'm not a financial advisor, but in my personal opinion, the answer isn't to panic and it isn't to gamble. It's to follow the same principle that have protected investor through every bubble in history. Stay consistent, keep investing systematically. Don't try to predict when the bubble will burst or how high it can go. Even the smartest people in the world can't time markets. The simple habit of investing a fixed amount every month has built more wealth than any perfect timing strategy ever has. When prices fall, you automatically buy more. When prices rise, you buy less. It works in every market condition. Diversify beyond AI. AI might be the hottest story right now, but no investor should bet everything on one sector. Spread your money across stocks, bonds, mutual funds, real estate, precious metals such as gold and silver. A diversified portfolio can survive any crash. Even if the market drops, let's say 40, 50 or even 60%, your entire financial life shouldn't fall with it. Don't panic if the market crashes. If there is an AI correction or a broader market drop, remember, every crash in history eventually recovered, and the investors who holds on or kept buying were the ones who ended up building the most wealth. Selling in fear locks in losses. Staying invested gives you the best chance of long-term success. Focus on your income. It's your real superpower. The more you earn, the more you can invest. The more you invest, the faster you grow. Whether it's a promotion, a new skill, or a side business, anything that increases your income gives you more fuel to take advantage of long-term market opportunities. That brings us to the final part. I personally think that we are living in once-in-a-generation moment. AI is real, the opportunity is massive, but the risks are also bigger than most people realize. You don't need to guess the future, you don't need to time the market. You just need a consistent, diversified, long-term investment, the kind that survives bubbles, corrections, and hype cycles. Stay calm, stay disciplined, and let time, not emotion, build your wealth.